Welcome to the Financial Symmetry Show. Chad Smith and Mike Eklund with you this week. And today we're introducing you to 4 typical investors we see during market declines. And because with stock markets, now sinking into a bear market, we believe it's a good time to take a step back and evaluate what type of an investor you have been and or want to be in the latest decline. And if you felt a little bit of worry or discomfort, you're not alone, because bear markets can shake the confidence of the toughest and steadiest investors. But by hearing the story of others, having an awareness of where we are, and taking inventory of what your specific plan calls for, it can help you to create a successful blueprint. So that's what we hope to do today. But before we jump in, you may find our latest guide containing 7 tips to help you prepare your portfolio for the rough markets we've been experiencing helpful. And you can check that out in our show notes by searching just 167. That's the episode number in the magnifying glass in the upper right-hand corner. If you're looking at it on mobile, you have to hit the 3 lines at the right and use the magnifying glass on financialsymmetry.com. And we'll also include a link in the show notes to this show that you can check out if you're listening on your podcast app. Now, on with the show. So Mike, after meeting with hundreds and hundreds of families and individuals through the years, we've seen a few different things, right? And so we've picked out a few characteristics that we see and kind of organized it into 4 different types of an investor that we've created here for you that we typically see during market declines. So you want to jump into that first one there?
Yeah, no, I will, Chad. I appreciate that. Now, a couple things I'll say before I jump in is, and as you mentioned, meeting with hundreds of clients and prospects, a couple of things that we typically see is, number one, a lot of folks get in their own way. And these 4 individuals types would be good examples of that, because we have found over the years that investor behavior drives results a lot more than the investments selected. And that's a lot harder for people to think. They think, oh, wait, I'll just pick the next best stock or mutual fund or ETF, and that's going to be the success of my portfolio. But they don't realize, the decisions they make during times like this, during the good times and the bad times, are big drivers of their success. So I'll start with that, how important behavior is, and just the awareness of someone to think like, oh, wait, maybe I'm not doing everything I should be. I'm making some mistakes. I think it's important, because I think a lot of people are very overconfident in their abilities, not only in investing, but all areas of life. So that was just a little kind of update on that. I just want to mention that before we kick off. But yeah, so the first type of client or individual we see is what we call nervous net. We would say this is the most common. They're typically, when they see the market go down, the first comment is how much money I've lost. Now, I will say you haven't lost any money until you decide to sell. You make it permanent. They are very nervous and they don't have time to make it up. That's obviously a very common quote we hear. Like, how am I going to enjoy, spend money on retirement or my child's college or buy, take that vacation? Where am I going to have the time to make this up? And they probably experienced a bad experience in the past, either the global financial crisis, the tech bubble, COVID back in March of 2020, or whatever it was. They had some bad experience and they just remember that was, how bad that was. And they finally made up for it. And now they're going through this again. I'd say, they also second guess what they've done in the past. Like, why did they wait to invest? Obviously everyone knew the market was going to go down, so they should have just waited 6 months. They could have bought stocks at lower prices. So, they're nervous. They're nervous that, the decisions they make, they're kind of paralysis analysis, as Chad likes to say. But it goes back to the common quote we've heard from Richard Thaler, the professor from University of Chicago, Nobel Prize winner, that the pain of loss is 2 times as painful as the joy of a gain. So in this situation, those individuals are feeling the pain of that loss. The one thing I think they'll have to understand is there's a difference between risk, and risk is potentially that permanent loss, but really that risk is running out of money versus volatility. Volatility is what we're seeing right now in the stock market. It goes up, it goes down. 3 out of every 4 years it's up. 1 of the 4 years it's down. And so that's just volatility. Risk is actually running out of money. And really that can happen if you make poor decisions during market declines, like selling. You'd have a much higher probability of running out of money. So, Chad, you think about some of the questions you might want to ask yourself if you're in this camp?
Yeah, we talk so much about the financial plan, right? And if you can back up when you're thinking about your investment portfolio and ask yourself, what does my financial plan say I need? And then how much of that should be in safety, right? And there's varying number of years that people use for this. It could be 5 years, it can be 7 years of money that you need in safety to sustain you through a market decline. But without a financial plan in place, that can make you extra nervous because you don't know the answer to that necessarily, right? Or you may have too much, and that could be dangerous for your long-term outcome. So it's really understanding your specific risk needs and the need for expenses going forward, right?
Oh, that's great. And I think that reminds me of, Morgan Housel, a writer and author, always says the quote that we like a lot here. It's called, "I'm a short-term pessimist and a long-term optimist." And to Chad's comment, that money you need in the next 5 to 7 years should be in safer investments, cash, short-term bonds, high-quality bonds. I know bonds have not done as well this year, but they still have done better than stocks, and that kind of safe investments. And then, the money you don't need the next 5 years should be for long-term growth because, there's a lot of talk in the media today with inflation. If inflation averages, 3% over the next 30 years, you'll have, less than half the money you have today in purchasing power. So it's important that you understand what the risks are and you don't understand to be nervous, but you have safe assets and growth assets.
Yeah, I remember doing our show we did back right at the beginning of the coronavirus, right? The COVID crash, we'd call it. And one of the things we talked about there is controlling what you can control, right? Or focusing on what you can control, because there's always something to worry about. Right now it's inflation, interest rate rises, right? Then it was global pandemic, potential complete uncertainty of how we were going to proceed through that. And I pulled a quote that I like because we talk a lot about the financial headlines, and watching the news can be expensive, but Bill Gates had one and he said, "Headlines in a way are what misleads you because bad news is a headline by that very definition. And gradual improvement is not." So, it's just not as much fun to show very small progress over time to people. It doesn't, if it bleeds, it leads, right? So
there you go.
Okay.
Well, that's the first one. Just nervous
That's the
net.
first one. Yeah.
You want to tell us about the profile number 2?
Okay. So we got number 2 here that we've pulled through a few characteristics, and we call this one "Told You So Tabitha." So "Told You So Tabitha" is an investor that kind of allows regret to turn into this revisionist history, right? It's the classic, "I knew I should have sold more stocks. I knew it was going to go down and I should have sold more and waited," right? Because looking in hindsight, it's very easy to diagnose what's happened, but very difficult to know in the short run what's going to happen going forward. So I love the quote of a fellow investment writer in our industry, Ben Carlson. He had an article called "The 10 Most Dangerous Words in Investing" was the headline. And in it, he describes how those words are, "If you would have just put $10,000 into blank," right? Whatever that blank may be. Because if you tell yourself that enough, that starts to drive decision-making and push you in a direction where you might start to invest in things that might not have the best future returns. So it's something to think through and not always allow your past self to guide those future investment decisions, because you struggle. "Told You So" Tabitha struggles to see when things will bottom. She always wants to wait until things look better, right, before you invest. And the problem with that is the markets move incredibly quickly in the declines at extremes. So you may miss those moments if you're trying to wait. And by definition of that statement, you will miss out on some of those gains because you're going to wait till things look better, and things will look better after you've already seen gains in the stock market. So it can be a self-defeating mantra to use that in your investing thesis if that's what you've kind of hung to in the past. So we try to help people talk through that and think through that and give them the confidence with, again, that financial plan. But Mike, we also like to talk about evidence, right? And looking in the past there. So what kind of questions have we talked through with "Told You So" in the past?
I mean, just like you said, the evidence of what's happened historically. I mean, over the last 100 years or so, we've, on a 1, 3, and 5 year periods, after a 20% decline, the market's typically up about 42% after 3 years and 72% after 5 years. So typically we view market declines as, hey, these are buying opportunities. Yes, maybe you didn't, that "Told You So" Tabitha missed the sell opportunity, but still, if you don't have all your money in stocks, there's an opportunity to buy at lower prices, which means higher future returns. So I think that is the evidence, is that it's good time to buy. And even if you don't buy, sticking to your plan and following through over the long term, the markets have returned, the stock markets have returned between 8 to 10% per year historically. It's a good time just to kind of stay stay along with your plan.
Mhm.
But I would say we told you so, Tabitha. The other comment that I heard, and I can't remember who exactly quoted this. It was from a while back in the late 1800s or so. Is that the biggest obstacle to a good plan is the perfect plan, which just means that a lot of times people try to make everything perfect and they miss out on a good opportunity. So I think this is a situation where they're trying to maybe time the bottom, not sure the exact date to get back in. It's a good situation where just investing when the market is down, even if you don't pick the perfect bottom day, you're likely to do well over the long term anyways, as the evidence supports.
Yeah, I mean, this kind of parallels with the market timing, mistake that you can typically make in those moments. And we'll include a graph that we've referenced before, updated to show you what just missing 1 to 2 to 3 or the 5 best days of a market cycle do to that overall growth factor, because it's a big number. It would surprise you. All right, so that's number 2. Let's move on to number 3 that we typically see.
Yeah, so number 3, we would characterize as Defiant Dan. They have a hard time questioning their decisions. They're holding speculative things, maybe bought late in the bull cycle, and they want to hold on until they come back. There was, over the last couple of years, it's been pretty crazy. I mean, think about some of the meme stocks. You got the GameStop, AMC type situations. Obviously, crypto has been in the news for good and for bad over the last couple of years. So, they typically jump in and feel like they're still right, but they might have missed the timing. And they have a little bit of the FOMO effect, which is the fear of missing out. These individuals typically bought tech stocks in the late 90s. They bought real estate in 2005. They, last couple of years, they bought ARK ETFs, which is typically, the stocks that were very popular. We're on Zoom today. Zoom was a very hot stock because, people are all working from home. They felt like it was easy to get rich, and they didn't, as Chad mentioned, lack the patience of investing. As we mentioned many times on this podcast, investing should be boring, but they wanted to make it exciting, and now they're suffering the consequences because of it. Because even though the stock market is down, the S&P 500 is down somewhere around 20, a little over 20% as we record this, is a lot of those individual stocks, cryptocurrency is down 60, 70, 80%, which is a much larger decline than what we're seeing in the general market. This individual also tends to be, as I mentioned before, overconfident, I would say, and they want to kind of hold on. In addition, a lot of folks have what's called mental accounting. It's a kind of a behavioral finance term, but where they're kind of bucketing different money for different reasons, saying, hey, I don't want to sell these holdings because they're at a loss. I'll wait till they come back. Well, that's great, but they could take many, many years to come back. And the question to ask yourself is, if someone gave you that money today, would you buy those same stocks? Because it doesn't matter when they'll come back. It matters kind of how they'll do now versus the alternatives, which is what else you'd invest today. So any other thoughts or feedback on Defiant Dan, Chad?
Yeah, I mean, most of the time we want to defend our positions even more when we think we're right? Or we might have been wrong for a little while. We want to hold on until we're right. And that is the difficult part about investing, because it can really impair your long-term picture. And, we were talking during the call, the cousin of Defiant Dan is Anchoring Andy, right? And we're talking through some examples that we've had conversations recently, with some that there's an emotional attachment that it can be there that really holds you, and it's like a magnet that just has drawn you to this particular holding for whatever reason it may be. It can be a family investment. It can be an investment you made very early on and you were right, and you've made a lot of money up to the point where the stock was high. Now it's fallen back and you're still trying to hold on because there's an emotional pull to that investment. It can be very difficult to make decisions on diversifying across there. So I think the main question for a Defiant Dan or an Anchoring Andy is, how diversified? Do you know how diversified you are across your picture? We saw so many people coming in, towards the late end of that cycle. You talked about the ARK ETFs. We saw, heavy allocations to tech stocks and large U.S. growth. And why not? After 10 years of growth, right? That's what you're seeing, the positive returns leading up to that. So that's why investing is so difficult, because you have to be disciplined and move away from things when they're doing well. And they could continue to do well after you move away, right, from them. So incredibly difficult and interesting. It keeps it very interesting. But when you're dealing with your net worth and your life's wealth, interesting may not be the word you want to use with it all the time. So
once again, it goes back to investment behavior. That's going to drive your long-term results and having a plan. Most people don't have an investment plan or a financial plan. and then don't have a plan in place to what should they do when the market goes down. We've talked in previous podcasts about opportunities like opportunistic rebalancing, tax loss harvesting. There's some great things you can do, but you got to have a plan in place to start with.
Yeah, and we get so emotional about our money because we attach so many things to it of what we want to do with it, right? The goals that we want to accomplish in retirement, the things we want to do there, the people we want to gift it to, the people we want to share experiences with, what putting some dollar figures on all this, it can make you very emotional in those decisions you're making. But every once in a while, we'll talk to this fourth profile here that we have, and we call this one Steady Sandy. And Steady Sandy generally chooses not to look at the portfolio. This is the one where I'll have a conversation with this type of an investor and they say, you know what, I just hadn't looked at it this time. I see it on the news, but I don't realize what exactly is going on. And I feel okay about it. Now, of course, that's a conversation that she's having with a financial advisor. So luckily that likely gives her some more confidence in knowing that somebody's looking at it, right? Because you want to have attention on it. And it's not like she doesn't feel nervous. I mean, there's still a nervous energy there of, I could run out of money. This could be the one, right? They've all been temporary up to now, but this could be the one. So they still feel that, but they remember those past experiences of them being temporary, the declines, and what they learned from those, and the confidence that they had and the wisdom that they gained by going through that experience. So they're also open to kind of adapting their behaviors, like Mike was talking about earlier. If you've been through it a few times, you're likely more open to listening and trying to work and have some patience, which is incredibly hard for all of us to do generally. As a result of that drop and going through it, the experience can pay you in massive dividends in the long run. And I don't mean dividends just from the stock payments. It's just dividends from the wisdom that you gained, right? And helping you hold on. So, but at the same time, Steady Sandy there's still opportunities there, right? That she could take advantage of that she might not be without the guidance of an advisor or the experience and the fortitude that you got to have in the bottom of those cycles. So what are some of those questions, Mike, that we typically kind of talk through, or they may be asking us?
Yeah, no, and I would say before jumping those questions, Steady Sandy is probably the exact opposite of Defiant Dan. Where Defiant Dan is just, this is where it's got to be, and I'm not going to do anything. Steady Sandy, even though they're not maybe making changes, but they're at least open to adjustments. They're open to listening, but they could be guidance towards, should they, as we mentioned a second ago, should they be buying stocks during market declines? We call it rebalancing, but it's a chance to buy when things are lower, because lower prices typically means higher future returns. Are there any tax moves? Things called Roth conversions when prices are lower are great opportunities, because it gets you be able to put money into a Roth IRA at cheaper prices. Like I said before, tax loss harvesting, which will lower lifetime tax bills. So although it's kind of nice to put your head in the sand and not have to think about it, and not maybe see the balance decline, there are some opportunities that could be missed by not recognizing that there are things you could be doing.
Yes. So there's always things to discuss and tweak, but the financial plan is the baseline, the blueprint for where you start, because that helps you understand your personal situation and how much risk you need to take first, and then how much you can tolerate as well. So that's where we start. And so that leads us to this progress principle, that idea of those gradual wins over time. And this one for this week, I put down basically that just evaluate how you're feeling during these declines to see where you could either add some discipline or implementation where you may have been paralyzed in the past, right? This is a new opportunity that we're in now, that you could step back, take a look at our ebook, the 7 tips that we have there, read through those to see if any might apply to you, right? Some tax loss harvesting opportunities could be there with losses that you had in those tax moves. So, and revisiting your financial plan to test its durability, right? You want to look at those scenarios that you can say, what if I lose my job? What is that going to look like, right? What if I spend a little bit less for just a small amount of time? How does that impact things? So that can give you, again, more confidence. And then you also understand, what kind of return am I using, rate of return, because that's an important element. I mean, we ask that question, right, Mike, to every new person that walks in our office. What is your expected annual rate of return? And we typically saw that increase through the years there, some of those answers. And it's hard not to, right? Because you're influenced by the news just like everybody else, and by what your friends are telling you, or what you're hearing, what you're seeing through internet stories of specific, sections of really niche people investing in speculative things. It's hard not to be influenced by that. So Anything else you took away here from our 4 profiles?
No, I think I would just start with what you kind of talked about. Warren Buffett's famous quote is that the stock market is a device from passing wealth from the impatient to the patient. And I think that is important. I think that's if I think of 3 drivers to success as an investor, I think one would be faith in the future. Another would be discipline, because you have to be able to react in terms of what happens, in terms of having a plan, and then finally, like I said, just the patience to understand that returns are not going to happen. You can't create returns. I think you can't just look at your computer screen and just because you're looking at it, expect the balances to go up. They're going to take time, but to have a plan in place and faith in the future, I think you'll do very well over the long term.
Yep. So if this is your first time listening, we created this show to help you to think through things like this, to think through things maybe in a little bit different light. And the goal, of course, is to help you enhance your today and enrich your tomorrow by making financial decisions that can benefit you and help you have discipline through, in particular on the investment side of things, this episode. But we talk about tax planning, estate planning, many different areas of your financial life in our other 160 some episodes. So you can check those out and you can download the ebook, shoot us some show topics as well. We like to walk through those and appreciate all the feedback. Keep it coming. And then we'll talk to you again in 2 weeks.